as Joe mentioned, Scott's famous for a lot of things. He's a recovering entrepreneur, recovering investment banker, an attorney as well, as well as being, of course, managing general partner of probably the most well-known fund, most successful fund in the country or go to the world at this point. But he's recently written The Secrets of Sand Hill Road, and it's actually a very accessible book. It's easy to read. It explains the motivations of entrepreneurs and VCs very well, and helps, I think, serve as a guidepost for entrepreneurs as they go out to seek to raise capital. Well, it's gotten a lot of great attention. Eric Schmidt says it's the definitive book on navigating VC. Sam Altman from Y Combinator is a valuable resource for any founder who wants to work with VCs. Deanna Friedman, CEO of NASDAQ, says that The Secrets of Sand Hill Road is a definitive guide on how to engage the VC community. And our very own equivalent, the closest thing we have to Andreessen Horowitz here might be a Union Square venture. So Fred Wilson says on his AVC blog that what Scott does in this book is break down the process and explain it in plain English so that entrepreneurs can understand what's going on and why it matters to them. So he can put you in the same category as Brad Feld's Venture Deals and Jeff Buskang's Mastering the VC Game. He says you can teach an MBA or undergraduate course on raising capital for entrepreneurs for these free books. So obviously, the third book being your book, what made you want to write this book? Is it you're getting the same questions over and over again? You see entrepreneurs making the same mistakes? Was there something missing from these other books that you believe was important?
Yeah, it's funny. So I've been doing tech-related stuff for about 25 years. So I was a banker and then in a startup company, and obviously been doing this for 10 years. And I thought actually all the questions had been answered, but what I found was I kept getting entrepreneurs coming back to me and asking everything from basic questions like how does the business work and how do I kind of know what these terms mean, to there was this basic undertone of kind of how do I avoid getting screwed, I guess, by the venture capitalists. Is a simple way to describe it. And so I just felt like we have this unnecessary information asymmetry that exists between the VCs or in some cases obviously the lawyers who do this thing hundreds of thousands of times in their career, and the entrepreneurs who do this once or twice. And it just felt to me like it was just needless to have that level of asymmetry and kind of disparity between the parties there.
Well, as a lawyer, I see that a lot. I think that entrepreneurs come into the negotiations, the term sheet stage, and certainly definitive documents at a real disadvantage in that they, as you said, may do this once or twice in their careers, whereas the partner on the other side of the table, the investor, has done it dozens, if not more than 100 times. So it's a very helpful book. I want to just cover a few, it covers a lot of ground. I mean, I really liked how you went into the LP motivations. I thought that was great. But I'm going to talk about a couple things around aligning interest, team, and just your thoughts on the current venture industry, which you talk about at various points in the book. So let's start with aligning interest. So you're very big on this, and I think you really go into what motivates the VC, which is in turn what's motivating the LPs, and then of course downstream to the entrepreneurs. That you try and see an alignment in funding sources really going through those three groups of constituencies. So can you explain why this is so important and maybe share some experiences of potential impact of, say, misalignment?
Yeah, so I think the fundamental alignment, when everything works, basically, you've got, the LPs, right? You've got the investors who are looking for, obviously, hopefully, very high, abnormal returns from this business. So, if you can generate 2.5, 3+ times your money for people over time, then you're gonna keep your LPs happy and be able to do this. And so what that drives then is, right, it drives, particularly for a fund of our size, it drives the kind of behavior which is we need to invest in things that have a chance to be very outlier return drivers, right? And we talk about this in the book, but the way our business works is, our batting average is poor in this business, right? So we basically kind of, probably about 35% to 50% of what we do goes to zero. No matter how smart we all think we are, that's kind of what the attrition rate looks like. You got 20 to 30% of your business that kind of are okay, and the question really is what happens to that last 10 to 20%. So if you think about that alignment, then you've got LPs who are basically looking for you to kind of swing for the fences. You've got GPs who are hopefully trying to swing for the fences. And so you've got to have alignment then with entrepreneurs who also share that same objective, right? Which is, do I want to build a business that lends itself well to venture capital financing? So there's nothing wrong with smaller markets. There's nothing wrong with businesses that can, be nice lifestyle businesses. they just don't lend themselves well to that model. So yeah, where we see misalignment is number one, where you have an entrepreneur whose objectives are different than that, right? Which is, either they don't want to try to kind of, maximize the opportunity for the business. They're not interested in potentially going public. Sometimes, they're interested in selling the company before, maybe the opportunity is right. And so you just get these weird conflicts that are just unnecessary, which is if we go back to first principles, if you're going to take money, like, you got to make sure that you're aligned with kind of what the VC is looking for, which, there's, it's not a normative statement as to one being good or bad. It's just a question of making sure you got alignment across incentives.
Do you ever have situations where the TAM is there, maybe the founder market fits there, and everything looks good, but you just run across a team that just isn't prepared to partner with a venture fund on NVCA-style terms?
Yeah, it definitely happens. And look, more so, the big change, right, that's happened in the industry, and I'm sure you see it in your practice, is look, that the relative power of the entrepreneurs, the influence of the entrepreneurs has grown over the last 10 years, there's no question, right? And so there are definitely some times where kind of, everything looks good, and then you get down to the terms, and you're like, okay, can we live with this or not? And sometimes, look, there have definitely been times where we hold our nose and we say, look, like, we think the upside here is great enough that it's worth basically taking some, potential terms, whether it's governance terms or otherwise, that you're not happy with. So that does happen. I think, to me, the question, right, when you're doing these early stage investments, the question is kind of a what if question, right? So it's kind of, okay, like, if everything goes right, how big could this be? What could this thing look like, right? That's kind of the question you're trying to solve. And yeah, look, at the margin, you don't love to do it, but if you feel like, look, you can answer all those questions affirmatively and you have to live with some terms that might be suboptimal, as long as you don't feel like they compromise your foundational economic rights or that you have a governance structure that you just feel like misaligns the parties, then unfortunately the answer is, look, sometimes I think you have to do those things in order to kind of move forward.
So I've been using your example of quality. You just talked about your baseball batting average. I've been using your example of quality at bats, that you want quality at bats. And so if I guess even though you're holding your nose, you consider that a quality at bat, or you wouldn't go to the step.
Yeah, I think that's right. Yeah, I think that's right. And look, I mean, at some point you have to have some principles that you're not going to compromise, right? So, for example, look, if I don't want to compromise foundational economic principles, right? So, in other words, if I feel like I'm going to do a deal and the governance structure effectively allows you to undo that deal or do something differently, then that's, you probably have to draw the line there. But look, in today's day and age, there's no question that we accept governance terms that probably you would rather not accept, and certainly you wouldn't have accepted 10 or 15 years ago, because in some cases that is just the kind of price of admission for some of these things. And sometimes they work out well, sometimes they don't work out well, but you're kind of a little bit going on, your power of persuasion, your ability to build a relationship with an entrepreneur to make sure that kind of you can manage what may be a poor governance structure from a legal perspective with hopefully some overlay of a relationship and the ability to actually communicate effectively.
So I've been doing this for 21 years on the legal side, and co-founded a couple small micro funds, and seen a lot of term sheets over the years. Is it fair to say that I feel like we here on the East Coast tend to get pressure, as you say, founders are having more leverage. And I feel like we on the East Coast, our term sheets tend to start following from things like accepting safes here at the angel level to maybe not having participation in the term sheet, maybe not having redemption, maybe not having an accumulating dividend. Those are things that started in our experience in Valley term sheets and have been making their way here and more prevalent here. Do you feel like it's fair to say that at least in the Valley and perhaps everywhere, VCs are interested now more in protecting their upside than their downside?
I think that's true, and again, I think it's a function of the tide has just turned, right? So in other words, if you look very simply at the history of venture capital, kind of early 1970s, at least in the Valley, through the 2000s, it was characterized by kind of, money was the scarce resource, the VCs had it, and therefore, if you look at the balance of power, basically the VCs had the power relative to the entrepreneurs. And starting in the early 2000s, that whole bit just flipped, right? So, it became much cheaper to start companies. We got a whole proliferation of these seed funds. You have things like Y Combinator, which have done great things that helped educate, entrepreneurs and stuff, and we completely changed that relative balance of power. And you had, essentially, the Facebook, the Mark Zuckerberg Facebook kind of, term sheets effectively now kind of, became the templates that the lawyers in the, in the Valley started using. Yeah, look, I think my sense is that the delta between East Coast and West Coast doesn't exist in the same way that it used to, probably certainly 10 years ago. And I think that's a function of just availability of capital and of the fact that also, look, people will get on planes where they might not have done that before, right? So, my guess is if a New York entrepreneur feels like they're getting, kind of not a fair deal from a New York VC, they're perfectly happy to go to Boston or to get on a plane and go to California and, see if they can get some of its market. So I just think part of the, the good thing about democratization is it does level the playing field. The question is, it depends on which side of the playing field you're on, whether you like that result or not.
Your book's an attempt to do that too.
Yeah.
So speaking of we companies and corporate governance and Uber and the CEO stepping aside there, both of those companies share one common trait that they've had to deal with this year in public market pushback, which is a lack of profitability. And one of the things you say in your book is that you're focused on the market up to the TAM, and it's got to be large enough to generate quote unquote profitable, high growth, several $100 million revenue business over a 7 to 10 year period. Yeah. And those two companies have hit some headwinds over profitability. What is your take on the how fast a company's got to become profitable for you to be interested in? I've heard over time people say, we don't care about profit, we care about growth. Where are you on that?
Look, I think with the whole thing, so there's, so first of all, this changes, right? Which is the capital markets will change their definition of what they view, right? So if you took a step back and you looked at like 2012 to 2015 in the public markets, basically, the public markets were very interested in kind of grow as fast as possible, right? So a 75% grower was more highly valued than a 50% grower. I wouldn't say completely independent of cash consumption, but almost, it didn't matter that much on cash consumption. Certainly we're in a market now that's kind of changed where, kind of good growth is definitely highly valued, but good growth with reasonable prospects to get the businesses to cash flow break even. And I think maybe that's a function of, it just may be a function of where people's perceptions are and what the risk appetite is in the public markets right now, and whether we're in a late cycle or not in a late cycle. I think people have a greater sensitivity to those types of issues. I think the we stuff that's going on, I think we is basically, I think it's a class of one, is my view on it. So I think if you look at kind of what's happening in the public market's appetite towards these companies, I think you have kind of a tale of three cities. You have kind of traditional enterprise software companies like, a Slack or an Okta or a Zoom, or some of these companies have gone public, 35, 50% annual growers, maybe not profitable today, but I think everyone can digest and understand, okay, like we expect that an enterprise software company will ultimately get to profit. It will have 70, 80% gross margins. We know at scale these things can have 20, 30, 40% EBITDA margins. And so the market generally is fine with that, as long as you're not like, consuming cash, I think, crazy. Then you've got kind of what I would call like the middle companies, and maybe Uber falls into this, which is high growth, high cash consumption businesses, right? But with business models that at least I think people know how to value. In other words, they're marketplace models. We've had marketplaces before, right? We've had eBay, we have, the Airbnb is out there, obviously now it's a public company. People understand the basic idea about how you kind of value these things. And I think those are, they haven't traded as well in this market in part because you've got a lot of risk and uncertainty in this market, whether it's late cycle or whatever the concerns are. And so not surprisingly, things that are potentially reliant on the capital markets for additional capital to get the cash flow break even have a little bit more sensitivity in this market. And I think we is kind of a little bit on its own, right? Because it's got the combination, it's got some combination of almost every concern that's out there, right? It's got governance concerns, it's got obviously cash consumption concerns. It's got a fundamental business model concern, which is how do you value this company, right? Is this ultimately a technology company, or is it ultimately a real estate company? And therefore, what will the long-term margin structure look like? What will the multiples that people assign to it? So I think that one, I guess my quick conclusion is, I don't think that is going to determine that's not dispositive for whether there is an IPO market or there's not an IPO market. I think that's a little bit unique in terms of some of its own issues, and my sense is obviously they'll go back to drawing boards and address some of the concerns that they heard from investors. But that aside, to answer your to go back to your first question, yes, look, like we are interested in things that can grow at scale for very long periods of time. You have to be able to produce cash flows in these businesses ultimately, because that's ultimately how they're going to be valued. There's no question about that, right? In the long run, everything will be valued at some like PE multiple or at some like EBITDA, cash flow multiple. I do think there's probably lesser willingness today, just given the perception that we might be late in cycle, for people to say, look, if you're dependent on the capital markets in order to achieve that growth, then you're probably going to have some inherent discount to it. But fundamentally, if these businesses work at the unit economics level, and you're really talking about kind of cash consumption that's being driven by sales and marketing and kind of, expansion. If you feel like, look, if you had a cash constrained environment, could you still run the business in a way, albeit slower growth, could you run it in a way that would be profitable? Then I think most people still have pretty good appetite for that type of business.
So let's turn attention to team, which is a big part of your book. You mentioned that you encourage entrepreneurs to focus on the team part of their pitch for capital ahead of even product and market size. Why is that?
Well, partly it's because it's the only thing that we can actually focus on, right? So the reality is, look, we can make guesses about market size, but they're probably all going to be wrong, right? Unless you're literally going after a market that's an existing market where it's clear how much money somebody's spending on. I talk about this in the book, but look, like, what was the size of the Airbnb market when they started, and what was the size of the Lyft market? I don't think anybody has a great way to do that, other than I think you can imagine, okay, you had proxies for it, right? You could say, well, the Lyft market is the taxi market, or the Airbnb market is some function of the hotel market, both of which would have been wrong. They actually would have been wrong on the low side, right? You would have underestimated what the opportunity is. So we can kind of at least get a directional view as do we think the market's big or not. But after that, the most important thing that we can evaluate at the early stage is the team, right? There's no financials to evaluate. The product in many cases hasn't shipped, and so we can opine on, again, do we think that if this product existed, would customers buy it and people pay money for it? But again, it's a little bit of kind of finger in the air. And so a lot of what we're trying to figure out is, okay, let's assume we get ourselves comfortable it's a big market. What makes this team uniquely suited to be able to win that market, right? So what is it what secret do they know that no one else knows? How do they earn that secret? What are the leadership characteristics they have? What are the storytelling characteristics they have that will enable them to actually be able to take a fairly raw vision and somehow turn it into an actual business? And look, those are still imperfect guesses, quite frankly, in terms of our ability to do so, but I think that's the most tangible thing we can actually sink ourselves into. And I was saying to somebody today, look, we kind of are part psychologist and part investor, right? Which is, we're trying to kind of intuit, how will this team develop over time as the market changes, and how will they respond to it? And that's a lot of what the evaluation tends to be.
So you touched on something I want to ask you next, which is what experience does the founding team have that makes them uniquely qualified to attack this problem or this opportunity? Until I read your book, I think maybe everyone's thought about that in the venture space, but I never really heard someone get into the product. You hear a lot about product market fit. Yeah. I've heard less about founder problem or founder opportunity fit. Yeah. Can you talk? I really like that part of the book.
Yeah.
When you expound on that a little bit.
Yeah. So we use the term internally, and I don't think it's not like a secret term, but we talk about founder, kind of founder market fit in the same way that you would talk about product market fit, right? So product market fit, of course, is literally the fitness of the product to the need of the market. And the idea of founder market fit is the same thing, which is, again, assume these are going to be big markets, therefore they can be competitive. And so again, your fundamental question you're trying to answer is why this team versus any other team, right? So there are likely to be many companies in this space. Why do I kind of want to select this team? And a lot of what we're trying to figure out there is, what do they uniquely know that maybe someone else doesn't know, based upon either their educational background or some experiential background they had, or something which makes them more capable of addressing and understanding and try to solve the problem. That's the foundational principle we're trying to go after, is kind of, again, their fitness to the particular problem in the market. The one big counter to that, and I mentioned in the book, is Herb Keller, who's the founder of Southwest Airlines, actually was a lawyer by training. And I put this quote in the book, but when he started Southwest Airlines, the big question his investors asked him was, why are you uniquely qualified to start an airline? And he said, because I've never actually been in the airline business, I know absolutely nothing about it. Now, it was probably, that may be a little bit of a historical exaggeration, but there is an interesting kind of, opposite of the founder market fit question, which is sometimes for industries not being kind of, not having come from the industry and have understood all the issues and all the problems and all the challenges, might actually free you up in a creative, entrepreneurship endeavor to actually have a very different take on the business. And so, I wouldn't say that like that, we don't necessarily look for that, but you can imagine in like highly regulated industries and things of that sort, that potentially being free from kind of, some constraints on your thinking might actually be a valuable place to be.
I also think not knowing what you're doing, certainly I didn't know what I was doing, getting started in a law firm early. If someone had told me all the problems and challenges we were going to face in the early years, going through the internet winter after the bubble years, it might have scared me off. Just sort of going into it blindly and thinking it would be a lot of fun was I see that in a lot of entrepreneurs that I work with too, that they just have this fearlessness and nothing to lose attitude about it.
Well, it's true, and we, it's funny, we have the exact same problem with respect to partners in the firm. So we all came from this business called BlockQuad, which was, effectively what Amazon Web Services successfully is now. We tried to kind of do that business, 20 years ago now. And when we first started the venture firm, anytime we would see something that kind of looked like that space, that came from that space, we would run screaming, right? Because we're like, oh my God, we know all the problems with that business. Like, that's horrible. We never want to touch that again. And so there is this weird dichotomy, which is you obviously want to be expert in particular areas. You also want to make sure that you learn the right lessons from that expertise and don't allow it to basically kind of cause you to redline neighborhoods essentially and decide that, look, there's no way we would ever touch a cloud hosting business. That was clearly the wrong answer, right? Had we seen Amazon Web Services as a venture bet in 2008, 2009, like, we would have been idiots to not fund it because we were so scared of the kind of past horrors that we had seen in our own business. But you can easily kind of find your way into those traps, and you have to really be careful in the business not to basically wage the last battle with some of the kind of scar tissue that you already have.
Well, for those ventures where there's no scar tissue, where there's an exit, and obviously those entrepreneurs tend to get backed sooner and quicker, maybe by their prior investors if it's a happy event, or maybe they attract new capital. Is there a tipping point for these entrepreneurs if they've had such a big exit, where you fear that the motivation for them to burn the midnight oil isn't there for their next venture?
Yeah, it's a really good question, and we've debated this back and forth, and we've actually now, we almost have enough data in our ability to look at it, and I can tell you so far at least, there are no patterns, at least in our data, which is, so we worry about two things. So you worry about, look, there's this myth in the valley, right, which is everybody celebrate, VCs celebrate failure, which is, the farthest thing from the truth. Obviously, nobody wants to fail, but what we recognize is that failure is often a part of the startup process, and so, we don't necessarily write people off just because they failed. We want to understand, obviously, what happened. So there's kind of two types of second founder syndrome that we try to assess. One is, did you not succeed the first time, and you've learned the right lessons such that it will make you succeed, and/or you may have such a big chip on your shoulder from having failed the last time that we know you're going to walk through walls and you're going to absolutely get this one right. I mean, you mentioned Travis at Uber, right? I think Uber was his third startup, and his other two were not complete disaster failures, but they were nothing to write home about, right? And so I don't know him personally, but you can imagine that he had enough of a chip on his shoulder and a desire to kind of prove people that he was kind of successful as opposed to unsuccessful in prior businesses that motivated him, and could have been very, very strong motivation. The other side, though, of second-time founder syndrome is people who have had some success, to your point, and either they made too much money where it starts to kind of change their view on how hard they want to work, or they forget about first principles. So, in other words, we backed a couple of entrepreneurs who had very successful public companies. They made plenty of money, but they were still motivated. Notwithstanding having money, they were plenty motivated because they were motivated by other things other than money at this point in time, right? They were motivated by their own reputation. And so we didn't have a question there, but then what we found was they wanted to kind of start, they didn't want to go back to kind of kindergarten, basically, right? They wanted to kind of start the company as if they were already kind of in high school or in college, right? And so, their first hires were, the 10 executives that they worked with at their last company, or, they didn't want to go do all the kind of, product market fit work with the first 50 customers to go figure out the needs. And so you have, we found that's another failure case, is money notwithstanding potentially. It's the idea of are you looking to go back to kindergarten and learn to crawl again and go through this process? And sometimes we get those right, and sometimes we don't. I would say in general, the basket of second-time founders as a basket is a good basket, and for the most part, our default is we will want to back those people, but these are the edge cases that I think you got to be careful about.
Bill Gross says that timing, we're still on team, Bill Gross says timing is more important than team. So the question, as a truism, you hear a lot of it, I want to ask you your take on it. Does a good team have a better chance of succeeding against timing headwinds than a mediocre team with a tailwind or favorable market dynamics behind them?
I think it's always hard to be absolute on this. I think in general, I subscribe to the Andy Ratliff view, which is kind of, I think, somewhat similar to the Bill Gross view, which is that bad markets will always beat a great team, no matter how great your team is. If the market isn't there, there's almost nothing you can do. And the corollary to that is, which is kind of, I think, the eBay corollary is the if the market is just awesome, like you could almost, as Warren Buffett says, right, you could, manage these things, with a ham sandwich or something, right? And I think that's true too. So, and timing does matter. I mean, look, I'll tell you, like we were definitely, I'd like to think at least we were a victim of timing in the loud cloud business, right? I think we had this great idea, which is, okay, compute utility ought to be on demand. You ought not to have to worry about the servers, the networking, all that stuff. It was a great idea that like we couldn't execute in that time period, in part because some of it was literally timing of going through the dot-com boom, some of it was timing of the maturity of the technology. And it's interesting, so much of what we see today is ideas that didn't work before that now work, right? So, we had Chewy, you had Chewy.com go public earlier this year. Well, that was the second coming of Pets.com, right? That was a massive, failure for those of you guys who remember the sock puppet, commercials that happened, the Super Bowl. We're an investor in Instacart. It's still too early to say, but I believe Instacart will work this time where Webvan or Cosmo, somebody was talking about Cosmo in New York the other day, right? I mean, Cosmo blew like a massive crater in the ground from a financial perspective. And that's not, again, I don't know the founding team at all there, so it's not to say the founding team was bad, but no matter how good they did, the business just couldn't work, right? Like you couldn't actually, somebody was telling me the story that, I think it was actually Mark was telling me the story that a good friend of his went to JP Morgan, was a trader in the days when Cosmo came out. And he said he loved it so much that he would order a Diet Coke every 30 minutes to be delivered to his desk. And of course, there was Diet Coke literally, in the refrigerator right down the hall. But he's like, this is the greatest business, right? Like, so every 30 minutes, like, and of course, the guy would have to go through security every time. And so, I don't know if it's a true story or not, but I guess the point is, look, like, timing matters in this stuff, right? So, like, the market size was not big enough. Like, people didn't walk around with, supercomputers in their pockets and stuff. I mean, you couldn't do Lyft and Uber don't exist, but for smartphones, Airbnb doesn't exist. So, yeah, look, I think timing matters a lot, and you can, look, good management teams can do a lot of things, but if fundamentally, like, the market isn't there, or the timing is not there, or, you're, for whatever reason, you can't get funding for these things, I think, unfortunately, those do matter.
So what advice would you give to teams about the problem they're solving, the opportunity they're seizing? A lot of times, I think entrepreneurs they've got a problem they're solving that's just not a priority for people, right, or an opportunity that is just not that big. What advice would you give to entrepreneurs? I mean, you talk a little bit about in the book, maybe you can share that with us, in terms of their pitch and refining their ideas about what problems they're solving and opportunities they're working on.
Yeah, so we talked a little bit, I talked a little bit in the book about the difference between aspirin and vitamins, right? So, obviously, if you're, vitamins are nice to have, right? But it's okay, like, if you forget to take your vitamin in the morning, you're probably not gonna go turn the car around and go get it. But, if you've got a headache and you don't have your aspirin, you're gonna go, stop at the Walgreens or CVS or whatever you have to do. And I think adoption of technology is kind of the same way, which is, right, like, it's very hard to change consumer behavior, for sure. And so, we use this euphemistic term of, it's got to be 10x better, which is a complete made-up number. But the idea is, in order for something to actually get adoption from a technology perspective, it's got to be orders of magnitude better than what people think about it. So I think that's the first thing, I think, to your point about, kind of how to think about it as a team is what's going to compel some new customer, whether they're an enterprise or they're a, kind of individual consumer. Why will somebody change their behavior patterns and actually buy what I'm selling? Like, is this solving a fundamental need they have in the business, right? Is it an aspirin as opposed to a vitamin? And it's very hard to build successful vitamin businesses just because, again, like, they just don't, it's very hard to get people to change their behavior. There's a famous quote from Max Planck, who's a physicist, he's a German physicist, and I think I'll probably butcher the words, but he basically says, look, technology advances one funeral at a time, right? And it makes sense when you think about it, which is, look, like, again, it takes a long time, it takes generational transitions for people to walk around with cell phones. It takes generational transitions. I mean, look how long it took for consumerized technology to make it into the workforce, right? Like, how many board meetings did you go to where, like, some random board member would come in with an iPad, and then you go back to your desk and you're like, why do I have this horrible desktop, and this terrible software, right? I mean, so all these things take time, and so I think, the best advice, I guess, to the extent I can give it to an entrepreneur is you have to just recognize, like, how difficult it is to change consumer behavior, and if you aren't solving a fundamental need in a way that is just so compelling, it's probably more of a nice-to-have business than a must-have business.
So let's change to the industry.
Yeah.
You make a few points in your book about the disruptors in the venture industry, but much later in the series, what effect is Vision Fund having on the industry today?
Yeah, it's interesting. Vision Fund, Actually, I would say today is having a lesser impact on the market than it did 3 or 4 years ago. And I think the reason for that is kind of when they first started doing stuff in like 14 and 15, they were a class of one, right? So there was certainly nobody who had $100 million fund, and there was nobody who could write 100, 200, 500, or $1 billion check. What I think has happened over the last 4 years, and we can debate whether it's a good thing or not, is that area of investor has fleshed out a little bit more, right? So there are, we see sovereign wealth funds coming in and writing, checks of that scale. Even like traditional private equity firms like KKR and TPG and GA, kind of now are doing that. The mutual funds and hedge funds, the mutual funds and hedge funds kind of go in and out of the market, but the hedge funds are still fairly active. I was talking to somebody here today, firms like D1 and some of these other guys that are out there, so these New York-based firms. So none of them have $100 billion funds, but there are many more people now who could write a $100 to $500 million check. There's probably still very few people who can write a $1 billion check. And so I think the impact of SoftBank when they first came out was they probably had a lot of market power because they could go study a space and say, hey, look, there's 4 companies in this space. We are going to effectively kind of kingmake one of them, right, by giving them $500 million. And so that was a scary prospect, right, if you were on the losing end of that, right, even if you didn't necessarily need $500 million to know that your competitor had that much cash. Whereas today, I think there's a better equilibrium in the sense that just because SoftBank funds somebody, there could still be another person in the space who gets funded by, let's call it TPG or KKR or somebody like that. So there's no question they have a big impact, but I think that end of the market has filled out over the last couple of years. Now, as I said, we can argue whether that's a good thing or not. Maybe that's not a good sign, and we all need to kind of be mindful of that happening. But it does feel like the direct impact of SoftBank has actually been mitigated to a certain extent as a result of that change.
Let's talk about another late stage source of financing, IPOs.
Yeah.
Why do you think companies are staying private later? There's a lot written about it, but I wanted to get your take on it.
So yeah, I've written about this and had a chance to kind of go spend some time with the SEC and with some committees in Congress. My personal view is what's happened is if you look at the data, you'll start to see IPOs falling off kind of late 90s basically, right? With the exception of the bubble days. So 99-2000 was, it was a very unique time period. You had 750 IPOs in that 2-year period. But if you basically abstract that out, you'll see kind of starting in mid to late 90s, the number of IPOs per year dramatically changing, and you'll start to see the nature of IPOs, meaning kind of the size and the scale of the companies at IPO starting to grow as well. I think what happened is, the SEC put in a bunch of these regulations, for those of you who follow markets, right, Reg NMS and all these other things that were designed to increase the efficiency of the markets, and they did a wonderful job, right? So there's no question today, right, that spreads are as tight as they've ever been. You can get 495 commissions from Schwab. I mean, it used to be very, very prohibitive, especially for retail investors to be able to trade. The challenge, though, I think, is all those things work very well for very liquid, kind of high-volume stocks, right? So you can have HFT guys and other stuff who can, make money, trading IBM and Apple and all they want because they trade, millions and millions of shares a day, and so tiny spreads on those things are fine for people to kind of support their businesses. What's happened, though, is if you go down to the lower end of the market, what we used to call small cap, but kind of call it certainly sub-billion-dollar market caps and probably $2.5 billion market caps. What you start to see is you have very low liquidity in those markets, meaning kind of you don't get a lot of share trading in those markets. And so therefore it's very hard for institutional investors to play aggressively in those markets because you kind of pay a tax when you go in the stock and a tax when you go out of the stock, right? Because you move the market because of low volume. And then we used to also have, by the way, right, we used to have investment banks that would cater to that end of the market, right? You probably remember this from your days, Hamilton Quest and Alex Brown and Robertson Stevens and Montgomery Securities, all those people went away. Thomas Wiesel, right? All those guys went away too. And so if you're a small cap company today, basically you're likely to have very little research coverage. You're likely to have no, or very little kind of, sales and marketing activity coming from the banks. So you're not going to have kind of very liquid markets. So my personal view is that's what's happened is we had these changes in the capital markets that basically made it to the point where it's just not a good place to be a small cap company anymore, particularly if you have to raise money in the capital markets, if you have to do follow-on offerings and stuff like that, because that's a hard place to be. And so I think what happened then is, look, I think we all, kind of then told our companies, look, you don't want to be a small cap company, wait till you get longer, and then the money kind of then came. So the big change then, I think, I may be alone on this one, but I think the public money followed all those activities as opposed to those activities followed the public money. What I mean by that is, as a result of growth no longer happening in the public markets, I think that's what caused Fidelity and T. Rowe and the mutual funds and hedge funds to kind of come down into the late stage markets, because they're like, look, if I can't get growth in the public markets, I've got to get growth in the private markets. And so I think we kind of started this problem with a lot of this kind of good, well-intentioned efficiency stuff. I think we now are at a point where it's just very hard to kind of sustain a sub, call it $2 billion market cap company, and so nobody wants to be there. And it's not, like, personally, as I've written about, look, I don't think it's a good thing, I think it's a bad thing, but selfishly for any of us in this room who get the benefit of investing in those private markets is a good thing in the sense that more and more of the appreciation, I think over the next 5 or 10 years, it will continue to accrue to private market investors relative to public market investors.
So last question on the industry. I mean, Andreessen Horowitz, you and Ben and Mark came in and disrupted the industry 10 years ago. There was no Andreessen Horowitz, and now you're such a big part of the landscape. A landscape dominated by, at that time, Sequoia, Menlo Park, Menlo Ventures, and TCV and others like them, Benchmark Battery. You mentioned in your book a couple of disruptors. What could disrupt your business model now? You were a disruptor, and now you're sort of an 800-pound gorilla. Well, you mentioned ICOs. You mentioned crowdfunding. Could you talk a little bit about that? And do you see those sources of capital as likely to disrupt the VC model, or is it just going to be supplemental?
Yeah, so I think the fundamental principle to me around disruption is, so there's two kind of facets of disruption I think that could happen. One is, look, if all VCs are is a source of capital, then I think we will just disrupt ourselves out of business, right? And that was what we tried to, that was the disruption that we tried to bring to the business, right, 10 years ago, and I feel pretty good that we've been able to successfully turn that, which is, it goes back to what we talked about, right, which is capital's no longer scarce. There's plenty of money out there. There will always be somebody who's got more money than do we, and it's a lower cost of capital than do we. And so the fundamental question in an environment where entrepreneurs have choices is, why will an entrepreneur choose to work with you? So they don't necessarily doesn't have to be our model. There's lots of other ways to do it, but I think the way that VC will disrupt itself out of business is if literally all we become is a capital provider, because that's just a losing game, I think, now. That sustained the industry for the first 30 or 40 years. I don't think that will sustain the industry going forward. The other way that we or others will get disrupted is, look, there will be better and more cost-efficient and effective models to add value that are different, for example, than how we're doing it, right? So we have, admittedly, a very people-intensive, and it's a very expensive model. We have 180 people, and it's not cheap to maintain that, right? And what could happen certainly is somebody may come around and say, hey, look, I can do all the things you guys are doing for half the cost or a fraction of the cost, or here's other areas that you guys aren't doing. I think that's the kind of stuff we have to keep on our toes about all the time. But I think the fundamental premise to me is we are in a relatively non-capital constrained environment, and I don't, I'm not a macroeconomist, but I don't think that's going to change anytime soon. Whatever the Fed did today, we're going to be in a low interest rate environment, I think, for quite a long time. And so, if we don't have balance,
money's going to flow to the riskier asset classes.
I think that's right. Yeah.
So I want to cover just one last topic, because it's such a big topic of conversation in our industry, which is diversity.
Absolutely.
There's a recent study on diversity by Rate My Investor and Diversity VC that over the past 5 years, only 9% of startups were female, 17% identified as Asian American, 2.4% Middle Eastern, 1.9% Latin American, and just 1% is African American. And those are some pretty dismal numbers. Why do you think that both from the entrepreneurial side and the venture side of our industry has just been slow, been a laggard?
I think there's a couple problems. So I think one is, look, the nature of the business has always been a kind of referral and a relationship-driven business, and so, I'll use myself as an example. I was lucky enough to go to school at Stanford, and so look, whether I'd like to think I'm not explicitly biased, but I'm clearly implicitly biased by the networks I came from, right? Like when I'm hiring a job, I'm more likely to tap into my network. When I'm meeting people, we kind of have commonality through network, and so my own level of diversity is going to be heavily influenced by the diversity of the networks from which I came, which honestly are not very diverse, to be completely honest. And so I think if you believe that, which I think that's a big part of the problem, what we as an industry have to do is we have to make more of an effort to reach out to networks that are not historically connected into our industry, right? And so, for example, I'll tell you something we do, like when we hire for a job internally, we ask our HR team to say, okay, look, go make sure that we send that rec out to groups that might have, African American candidate pools, or groups that might have, female candidate pools, and at least make sure that we're proactively, in addition to putting it on the Stanford website, which we're going to do because we have access to it, let's at least make sure that we're trying to widen the funnel at the top in terms of like the people that we're practically reaching out to who might be good candidates for this job. Now, at the end of the day, everybody's got to compete on their own merits, but at least I think we've got to do a better job of like proactively saying, look, are there networks who have been traditionally left out of this business, and how do we reach out to them? I'll give you another example of what we're doing. We have this fund that we call the Cultural Leadership Fund that we started about 1.5 years ago. The LPs in that fund are African American influencers, so they're African American business leaders, or in many cases sports leaders who have been kind of big influencers. And part of the idea is to connect them into our portfolio companies for purposes of trying to kind of at least increase their influence there. But an ancillary effect of doing this is we allows us, we get inbound referrals now for African American led deals, or we get engineers who are African American who want jobs in the looking for jobs in the industry, and we can help connect them to our business. So it's things like that. We're not going to solve this problem overnight, but I think things like that we have to do more of, which is how do we at least make sure we communicate to the communities who've been left out and make it feel like, okay, there is a path for you in, and again, at the end of the day, you're going to be evaluated based on your own merit, but we've got to kind of like at least give you kind of an opportunity to get in the door. And I think in all these businesses that have these very heavy referral network-based businesses, I think you'll see that diversity is pretty poor in most of those areas, and that's not an excuse at all. I think it's just a reality of how the business works, and I think we've got to do, I think as an industry, we've got to do more to help solve that.
In past interviews I've seen you do, that kind of spoke to me, the lack of connection between networks, that seems to lead to sort of the reinforcement of the lack of diversity.
Yeah. Look, I think most people, look, I think most people are pretty well intentioned, right? Look, some people do harbor pure explicit biases, but like I'm generally an optimist in my view. Is look, I think most people are not like that, but people just don't. I think it's something we don't think about it right, which is look, our diversity is informed by the diversity of the networks from which we come, and again, for most of us in this industry, that's not a very diverse network, to be completely honest.
So one last question: what secrets are you not sharing with us?
Yeah, that's a good secret. It's funny. Somebody asked me this. I'm not sure. I'm not sure if there's any. As you started with asking about the title, I'm not sure if there's any secrets we haven't shared. I mean, look, the fundamental. All kidding aside, right? The fundamental premise behind the book was, look, could we level the playing field from an information perspective so that number one, you would have hopefully better working relationships between VCs and entrepreneurs, and then ultimately, selfishly, look, I want to see more entrepreneurship. I want to see more entrepreneurship here. I want to see it in, not just New York and Boston, California, by the way, like we ought to have it more broadly across the country. It's definitely happening across the world, right? So the US, 20 years ago, the US was 90% of all global venture capital. Today, it's about 50%. So there's no question that like we're doing better in terms of kind of ex-US, kind of diversity from a geographic perspective. But look, I think there's a lot more we can do. So, to me, that was the whole fundamental premise is could we actually get a conversation going that would kind of make this business hopefully more attractive and therefore, attract more people into entrepreneurship.
Well, you did a great job. Thank you so much, Scott.
Thank you.
Appreciate your time.